And with that, I'd like to welcome Alex Morsink from Equivasto. How you doing, Alex?
I'm doing great, Craig. Thanks for having me.
It's good to have you back. It's been a little while, and I know you've launched since then. So tell us a little bit about your launch, or people have
Yeah,
launched on your platform. Sorry.
yeah. So we've been working on setting up the Equivesto equity crowdfunding platform for several years now. And in May, we got our exempt market dealer license, which is required to actually operate the platform. So we've been working for the past few months to actually launch our first deals. So we actually have two deals now live on the platform, and several more coming this month and next month. We're really excited to have them on. They're both great companies, and I would encourage you to head over to equivasto.com and check them out. The minimum investment is only $100, and so it's really set up to allow the general public to have access to investing in great private companies.
Yeah, and I also want to mention that we want your questions. We like to make these as interactive as possible. So if you have questions about equity crowdfunding, questions about, today we're talking about how much to raise. If you have questions, put them in the chat room, put them in the Q&A room. We feel like we haven't done our job if you leave with questions unanswered. So whether it's right on our topic today or just because we have Alex or me in the room, put the question in the chat and Q&A window. And today, Alex, we're talking about how much we should raise. And
Definitely.
and the common wisdom would be, as much as possible.
Exactly.
So while you're getting your presentation ready, is that still would you recommend raising as much as possible?
Well, that's a great question, Craig. I don't necessarily think so. I think it really depends on the stage your company's at, but you probably don't want to raise the maximum possible amount of money almost at any time. As a founder, you probably want to keep as much of the company's ownership to yourself and your existing investors as you can. So you probably actually want to raise as little money as you can, as you really need, depending on the stage of your business. But we'll talk about that in more detail as we go through the presentation.
Great.
So we're going to talk about today how much money do you need and figuring out what that amount is. So we're going to look at figuring out the burn rate, figuring out development costs if you're building new technology or processes, and looking at a timeline for your business to make sure you have enough capital to cover any cash flow requirements. And then we'll also look at how much can you afford to raise. So talking about the effect on control percentage and the founder's dilemma. And this is a really sort of integrating conversation topic, and there's a lot of discussion around this. So I would highly encourage you to put your questions in the chat and we can talk about it all afterwards. So when raising, one of the most important things to keep in mind is what is your burn rate? So this is assuming your company is not yet profitable, but your burn rate is the difference between your monthly revenue and your monthly expenses. So it's really the rate at which you are using up or burning through your existing cash reserves. So you want to know what your burn rate is on a monthly basis so you can essentially calculate, if all things remain the same, how many more months your business can operate before you run out of cash and declare bankruptcy. Understanding what this is helps you get a clear picture of the operating costs you'll need to cover in the future when planning out how much to raise. The next important item to think about is the development costs. So if you haven't begun development on your next critical milestone or service item that your business is going to be offering, that won't now be included in your existing burn rate. So if you're going to need to do new development or product creation, you want to think about what the monthly costs related to that might be, and how long it's going to take to actually develop that whole product, or at least the next clear milestone related to that product's development. And you want to make sure you can understand that on a consistent monthly basis. And you want to look at the total and try to map that out. You need to think about what goals you need to reach over the coming months and how that will directly correlate to a change in the value of your business. And you want to think about how that will affect other areas in your costs. So you want to think about everything relating to these potential development costs. So not just, okay, I'm going to need to purchase some new technology, but also I'll need additional developers potentially, or I'll need extra hours from my existing developers. Will I need more software to support them? Will I need a bigger office? What are all the impacts of these development costs? You want to be able to think about what those will be and map them out on a monthly basis, so you can essentially combine your burn rate and your development costs on a monthly basis. Essentially, and this is a key takeaway, you want to raise enough capital to cover the next 18 to 24 months of costs for your business. Because raising capital can take at least 6 months until the funds are actually in your bank account, if you raise less than that, you'll essentially do all this work to raise capital. You'll have 1 or 2 months where you have enough capital, and then boom, you'll suddenly be back trying to begin raising capital again to cover your next several months. So you want to make sure that you raise enough, that you have enough months that you can focus on your business, you can work hard and actually achieve some key milestones to potentially raise the value of your business. But you also don't want to raise so much that you're giving away more of your company than you need to at the point where it has a lower valuation. So at the minimum, you want to raise enough to cover the next 12 months, but ideally you want to be raising enough to cover the next 18 to 24 months of burn rate added to any sort of additional development costs. And you want to try to be judicious when planning that out. The reason why companies always fail is they run out of cash. And so you want to make sure that you have a clear focus on what your cash requirements are, and potentially you want to actually overestimate a little bit your burn rate or your development costs so you have a little bit of breathing room. So that's how you can combine the burn rate and the development costs to figure out your timeline for raising. Your raise is based on your company valuation, and it's important to make sure when you're raising currently that you get enough funds so you can hit the critical milestones during the next 18 to 24 months that will allow you to raise your valuation by the time you need to go out for your next capital raise. It's really important to make sure that you are doing that and you're able to increase the value or the perceived value of your business between each capital raise. There are 3 types of capital raises: up rounds, flat rounds or bridge rounds, and down rounds. And I'll talk about each of those 3 right now. So an up round, as the name sort of surmises, is a capital raise with a higher valuation than the previous one. So this has an effect of increasing the value of each share and therefore increasing the value of the investment of the existing shareholders. So if you look at the example on the slide, if we have a previous valuation of 2 million and then the current round has a pre-money, so before the investment money is received, valuation of 3 million, we can see that this is an up round. The value of the company has gone up by $1 million since the previous round. During this round, we will be issuing new shares. So we're not selling shares of existing shareholders. The company has 10 million shares existing, as you can see, and they've gone out and created a new 1 million shares. So now there'll be 11 million shares in existence. So with the previous valuation of 2 million and the existing shares of 10 million, the old price per share was 20 cents per share. Now with the new valuation, the new price per share is 30 cents per share. So there's a clear increase in the price per share for the existing shareholders, and that translates directly to an increase in the value of their investments. So you've made your existing shareholders very happy. The existing control is 100%. So the existing shareholders, including the founders, before the round had 100% of the control. And by issuing 1 million new shares to new external investors, those existing shareholders will end up having 91% control after this round is completed. And so based on the new share price, and you're issuing 1 million new shares, you've raised $300,000, which means the post-money valuation, so the valuation of the company after the investment is received, will be 3.3 million. And it shows that there was a clear increase in value for the company and the existing shareholders of $1 million compared to the previous raise. So in this sort of scenario, the dilutive effect of more shares being issued to new shareholders, therefore the reduction in control of the existing shareholders, is superseded by the increase in value that these people experience to their shares. So even though they have less control, the value of their shares have gone up by enough that they're still happy and they're making money. So they're happy with you. So Upround is always the target. So that's why we want to make sure that we leave enough space and we raise enough capital during a round to actually achieve key development milestones that will allow you to increase the valuation of your business. The next type of raise is a flat or a bridge round. So as the name surmises, you're raising again, but there's no change in valuation. So this is not your optimal raise scenario. This is a passable or an okay scenario. Essentially, you raised money previously and your business is still doing well and it's still set up properly, but not enough time has passed since that previous raise, or not enough milestones have been reached since the previous raise that you're really able to justify an increase in the value of the business. So the price per share will stay the same in this scenario, and the value of the investment of the existing shareholders based on that price per share will also stay the same. And the effect of the dilution, so the reduction in ownership control of the existing shareholders, is essentially canceled out by the additional capital brought in by the new shareholders. So as you can see in the example, previous valuation of 2 million, pre-money valuation still of 2 million, 1 million shares are being created from new. There's no change in the price per share. The existing investors, their control goes down from 100% to 91%, and the new money coming in cancels out the effect of that dilution. And so there's no change in the value of the investment from the original investors. So they are not happy, but they're not sad. They're glad that the business is getting more capital and it can continue operating, and they haven't lost any money, but we've missed an opportunity to demonstrate an increase in value for them. So the scenario that we probably want to avoid the most is a down round, which obviously is when you're going out to raise capital at a lower valuation than previously. Ironically, a lot of down rounds are actually happening right now in Silicon Valley as companies sort of with just a pitch deck and a really exciting idea raised massive amounts, well over $1 million on huge valuations over the past couple of years that the founders essentially couldn't deliver on. So their valuations were too aggressive and too exciting. Their promises were too large. And while there might still be some great potential still in the business, they haven't been able to deliver the level of performance that they promised in their initial projections and pitch. And so now they're forcing to take a down round with a lower valuation to raise enough capital to keep their businesses going. So you're seeing a lot of those actually in Silicon Valley in the news. They're not really sort of talking about them, let's say, as much as many of the other large, exciting rounds that you hear about on Crunchbase, but there are quite a few down rounds actually happening if you dig a little bit deeper. And this is something that we want to try to avoid. So not only is the price per share of the existing investors going down, so it's a clear loss on their investment, they're also being hit with the dilutive effect because you're issuing new shares at this reduced price. So they sort of get double hit, and that's something that generally will not make them very happy. In our example, the previous valuation was 2 million. The current pre-money valuation is 1.5. Again, 1 million new shares are being issued. The price per share has dropped by 5 cents to 15 cents per share. and the existing control has gone down again to 91%. So you can see the change in the value of the investment has reduced by $500,000. So your existing investors have lost money here as part of this down round. I'm sure they're glad that you're doing what's necessary for the business to survive, so they haven't lost their full $2 million. But they're definitely unhappy that they've lost some value in their business. So again, not to overstate this, but you do a down round if you have to, but you want to make sure that you raise the right amount of money earlier at the right valuation, so you don't need to experience a down round. So now we've talked about how much you need to raise in terms of making sure you can cover your costs for 18 to 24 months, and you raise enough at a fair valuation so you can reach your goals and milestones and help raise the valuation of your business in the future. But there's another whole side to this, and this is where a lot more nuance gets involved. And it's how much can you afford to raise? So when raising, the amount of control that you give up is entirely based on what is the value of the company and how much money do you want. It's a straight ratio. And as I mentioned on the slide, issuing capital is a dilutive exercise. So there's a pie which represents the ownership of the business, currently fully owned by the existing shareholders. And when you go out to raise money, you're turning it into a slightly larger pie and you're creating new pieces of the pie. But in terms of the percentage of the pie owned by existing individuals, that goes down. And so you really need to keep in mind, okay, how much ownership and how much control is being given up every time you raise capital. Craig always likes to say the early raises of your company will be the most expensive capital you ever raise, which is very true, but it can also be some of the most worthwhile because it's when you're getting your your social proof that investors will support your idea and believe in it. You're getting that critical capital you need to move to the next stage, and you're helping your business move forward and achieve success. So one thing that you need to think about is really the amount of capital overall you're going to need to achieve your goals. Potentially right now, if you're still rather early in the ideation phase or you're early in development, the amount of capital you might need to achieve your longer term goals might be larger than the existing value of your business at the moment. And so when looking at that, it's important to break down the total capital you'll need to raise into several manageable rounds with clear milestones in between that will lead to an increase in value. If you're trying to create the next Facebook, off the bat, you could probably say, okay, it's going to cost me $15 million in software and technology development and marketing to create this new social media network. But simply the idea of a new Facebook platform or a competitor to Facebook is not going to be worth 15 million off the bat, and it certainly won't be worth 30 million so that you're still able to keep 50% of your company. So you probably want to start much smaller, break it down into a more manageable milestone and say, okay, the first thing we want to do is create an online site where people can connect and send messages back and forth. And so you find a business case for this core idea, you determine the costs and funds needed to reach that milestone, and you try to create a valuation and go out to raise for that business where you're able to get just enough money to make it to that next milestone and sort of continue along the process. So that's one way to handle a situation where you realize the total capital you need is beyond the value of your business at the moment. But the challenge always comes down to how much of your company are you willing to give up? So it really is part of what's called the founder's dilemma. So it can be summarized well in the statement, you can own 100% of nothing or own 1% of something really large. So when talking with businesses, people come often to Equivasto and say, I would really like to raise $1 million. How much of my company do I need to give up? I don't want to give up more than 30%. I don't want to give up more than, they'll say these numbers. I don't want to give up this percent or this percent. This is the thing that I want to still control. And it's important to keep in mind, of course, what percent of your company you're still going to own after you go out to raise funds. But it's also important for us founders to be aware that to make your business successful, you will most likely have to give up over 50% control in your business. And coming to emotional terms with that is an important part of being a founder and really leading your dream, your goal, your business to success. If you can bootstrap and pay for your whole business entirely yourself, and you can do everything without any additional capital from outside, then congratulations, you have enough capital to run the business on your own. Then you don't need to worry about this. But the majority of us, the vast majority of us, are not in that same scenario. And coming to terms with the fact that you are going to have to give up large pieces of your business in order to make it successful. But if you don't do that, then your business won't get off the ground and you won't achieve that success. So this dilemma is something that, really we all struggle with to make that decision of what we're willing to do to make the business really grow and prosper. The average amount of percentage that should be expected to be given up during each raise is between 15 to 35% of the business. But again, that's assuming that you have a strong business idea, you've well thought out all the different aspects, you have a clear go-to-market strategy, and you have a strong valuation, and that ties in well with the actual amount that you're trying to raise to achieve your next milestone. So it's usually not going to be less than this number. And depending on whether your business idea is a good fit for sort of venture capital funding, the money you might require might translate to more than this percent of your business. And then you might want to rethink your milestones and your target goals. Really, you want to make sure that you're raising enough, based on the first conversation we had about burn rate and development costs, but you want to make sure that those costs are aligning with the future goals and potential of your business. If the costs are building up more and more and more, but the potential payout of your business isn't sizable enough to offset that, maybe that's time to step back and have a strategic think and discussion with your key investors and members about how profitable actually is this business, and is this the right way to be moving forward. That's definitely something that you want to be thinking about, before you actually go out to raise capital from individuals. You want to have that conversation yourself, because you don't want to be in front of a VC or someone and then being confronted with that sort of reality. You want to be prepared beforehand. And another really important thing to keep in mind as well when raising capital is closing the round and getting the funds is not the end of your journey with these investors. You're not fighting tooth and nail for that extra 1% so that you can be in control and these other people won't be. This is the first date, or this is the marriage proposal, and you've still got 50 years of marriage coming afterwards. So you don't want to start your marriage with these investors necessarily on the wrong foot. You do want to make sure you are thinking about and protecting your interests as a founder, of course. But you also want to make sure that you're not doing anything that would potentially damage or ruin the relationship with these people who are becoming your partners in this business. You want to make sure that your goals are aligned for as long as they can be. You don't want to pretend that their goals are your goals, because they're not. What you want to do is make sure, and what they're going to want to do as well, is make sure that the goals of the investors and the goals of the founders are aligned closely. And that really comes down to making sure that you pick the right investors, or you use the right mechanism or tool to bring in investors who are supporting your goals as a founder. You really want to make sure that everyone is focused on the same objectives and the same goals for as long as possible. And that way there won't be as much concern or fear when it comes to the control of the business. I try to look at external investors as an opportunity to gain insight and support from individuals who know different things than I do. And they're focused on the success of the business as well, not just you. And so part of being a founder is acknowledging that once in a while, I know not all the time, but maybe in a very rare instance, you might not know what's best for your business. And having someone else in there who does care about the business and does want the business's success, they can potentially help steer you away from a decision that could be damaging for the business long term. So that whole discussion about control and percentages and everything is important to keep in mind, but it's important to come to terms with and accept that, one, not everyone sees the same value in our businesses as we do, which is fine, but also that, we'll need to give up potentially control of the business so that we can make the business successful. And, not to be cliche, but it's a little bit like a child. Eventually your child grows up and you can't control exactly what your child does and where they go and what they say. Eventually they're going to go and become their own adult, but you want to make sure you put the things in place so that when your child does grow up, they're going to be making the right decisions and they have the right influences there. One last thing I'll mention about the founder's dilemma is 50% of the shares doesn't mean 50% control of the business. The board of directors is the organization or the group within the business that usually has the majority of the control over the actual goings on of the business. And usually when you have external investors, they will want a seat on the board. If you only have 3 board seats, even if it's yourself and your co-founder and the external investors, even if you still own 90% of the shares, you only control 66.6% of the board. And if eventually you have 5 board members, because you've had several rounds and you've got an external board member that's paid in there, suddenly you control less than 50% of the board. But again, it's not a situation where I control less than 50% and more than 50% is controlled by criminals who have come here to steal my business and take all my money and leave me destitute. It's I control less than 50% of the business, and other people who also care about the business and want its success control more than 50% of the business. But regardless, the business is 100% controlled by people who care about its success and making it profitable and amazing. And so you as a founder will always benefit by a scenario where there are people like that involved. So let's recap quickly. So how much should I raise? Well, you want to make sure you raise enough for 18 to 24 months of burn rate and development costs to hit the next milestone and potentially increase the valuation of your business. That's probably going to equate to about 20 to 30% of your current company value. If those numbers don't line up, you need to rethink something in between. You also want to make sure to pick your investors wisely. And you will most likely need to give up majority control of your business eventually in order to achieve your dreams, and that's okay. And taking the time emotionally as a founder to think about all the different steps and pieces of the founder's journey, going from you own 100% of essentially nothing all the way to owning a small percent of something amazing, and all the challenges and struggles that come in between is an important part of being a successful founder. Thank you very much for listening to me ramble on about emotional awareness and raising money, and I would love to hear your questions.
That was great, Alex. We've got a lot of questions, and so let's start with the early one and the one probably at the core of all this. How is a valuation determined?
Great. That's a very good question. So valuations are determined by a combination of essentially art and science. So oftentimes it really depends on the stage of your business, but let's assume that your business is just getting started. It's sort of pre-revenue, or you've just barely hit revenue. You've got some traction, you've got some customers, but that's sort of the stage that you're at. Let's also assume that you're running essentially a startup. So you're running a business that's hoping to scale and grow very rapidly from a small business to a large business, and it's something that can potentially be expanded globally. So in a startup that's sort of in a seed or pre-seed stage, how can you value your business? In that sort of scenario, we're really looking at the science side, which is, okay, what sort of traction do you have so far? What is your, what do your projections look like? And, we all know that projections are all made up, but it's really, how is your thinking represented in your projections? What sort of assumptions are you using? Projections represent a clear demonstration of the thought processes of the management team. And so understanding the projections really shows your future goals of your business and what you're trying to achieve, and also shows how detailed you are about it, how well you've thought this through, and how you see you can go and then achieve those goals. So that's the sort of science side, looking at your projections and your potential earnings in the future and working that back. And then there's the art side, which is looking at the actual business model, the business market fit, looking at the team, looking at how well they work together, looking at whether there's confidence that the team can actually deliver on the goals they've laid out in the business plan, all sorts of things like that. So they sort of combine together to create this sort of art and science valuation situation. I hope that was really clear. I don't think it was. It's probably a very murky explanation, but that's what I've got for now.
I think that explanation is good. And I mean, we've done a webinar on valuations, but let me maybe ask it a different question. What's the difference in the valuation process from your first raise to your second raise?
That's great. There's quite a large difference. The first raise is all hope and possibility, and whether there's any sort of confidence in the things that you've said and whether you can deliver on those things. The second raise, there's proof now, because you've got all those projections, you've got all those goals, all those milestones, and we've got what's actually happened and the reality of those things. So we're still tracing along to see whether you're actually going to achieve the goals that you've laid out, but we have proof now. So during the second raise, people are going to be looking at, what were your goals previously? Did you meet and achieve those goals? And how closer are you to actually getting the profitability and the revenue that you've been promising this whole time? How well has your team worked together? What obstacles have you overcome since then? Critical piece is this second round more money from the existing investors, or is this new money from outside? Are the existing investors participating? Why or why not? All of this comes in when you're thinking about you're doing a second raise. So there's a lot more review and potential to actually get tripped up as a founder when you're doing your second raise.
And back to the first valuation, when you're doing your projections, are your projections for a year, 3 years, 5 years?
So again, we all know that projections are sort of made up conjecture. A lot of people, it sort of changes what VCs are looking for over time. People used to want longer projections, and now they're saying, there's not really any point. Maybe we just want 3-year projections. 1-year projections are a clear sort of immediate path demonstrating what you're literally going to do over the next month to continue towards profitability and pay the bills that are coming up. 3 years gives a little bit more scale, and now you're taking it from an operational task, which is covering cash flow requirements, into a strategic one, which is how are we going to go out and hit these different milestones. The 5-year projections, I still like. Many people don't really do 5-year projections anymore. I see the value in them, not because I, for 1 second, think that your business is going to become worth, however many billions you're saying it's going to be worth in 5 years. But I want to see how lofty the founder's goals are in 5 years, and how well and what assumptions they're using to get them to that amount in 5 years. Because none of this stuff is actually going to happen. It's all conjecture, but the way the founder thinks about getting to the 5 years and how have they changed their projections to reflect and sort of compensate for that potential future is really what I find interesting when looking at projections. So I think 3 years is sort of a good spot for many companies. I like to ask for 5 years, but I think 3 years is where most people will end up.
So I had a question from one of the founders of Bloodflow at bloodflow.io, and they're wondering how soon should companies talk to Equivasto to see if they're a fit to go on to raise money on your platform.
That's a great question. We can talk to companies at any time. It's not the sort of thing where we're, big, mean, scary people. So if you come and it's too soon, I'm not going to be like, how dare you speak to me? Get out of my email inbox. It's more of a friendly conversation. So the earliest companies can be to raise with us is they have a minimum viable product or demo version of their product or software, or have a proven track record of success. So they already have some sales or sales traction. That's the sort of minimum. But we're still happy to talk to companies before that and after that at any stage to talk to them about, what equity crowdfunding looks like and whether it might be a fit for their business. I think one thing that, a lot of companies might not realize when talking about equity crowdfunding is, yes, if you have all the requirements we list on our website, we could technically review your company and put you up on our platform in just a few weeks. But equity crowdfunding is really about going out and capturing your own community and your own network and planning the marketing around how you are going to do that, as well as how we can bring our community to invest in your business, takes considerably more time. So even if you're thinking, oh, maybe I want to equity crowdfunding in 6 months or 9 months or something like that, talking sooner with us, we can help give you some advice and tips saying, okay, great, you want to potentially crowdfund in 6 months. What can you be doing right now to actually be preparing and growing your community? Oh, you should create a private Facebook group. Oh, you should create an email newsletter. Oh, you should consider this. All those little things that you can build organically over the next couple months so that you can potentially save thousands of dollars on marketing costs later on. So that's a long-winded answer, but you can talk to us anytime.
And I think they've already booked for you a one-on-one session for this Friday, and I'll put that link in the chat room if anybody else wants to talk about that. We've got a lot of questions around down rounds and whatnot, but let's start with this one. Is there a rule of thumb for how much ownership the founder should be left with after multiple rounds, plus incentivizing employees with shares when the business is in a steady state? Presumably that determines back solving how many rounds one can do and how much equity they can give up through those rounds. Are those factors you need to consider?
Yeah, so those are all great factors. Usually every time, I'll just answer the first part about the employees first. So usually every time you go out and do a round, you actually want to make sure that you increase a little bit the float of shares that you keep for employee reimbursement or employee stock options. On average, that's between 5 and 10% for companies. If you're a tech company, it can get as high as 15%. Or maybe even 17 put aside to potentially be rewarding employees because developers are really what's creating your essential product. So you essentially want to be increasing the number of shares in existence for that every time you have a round as a part of that. And part of your negotiation with the investors will be, when does that actually take place? So if the shares are increased for employees after they have invested, then they're being diluted as part of that. So usually they'll like to say, okay, assume our investment, now increase the float, and now we'll buy our shares so that they're not as impacted. But investors from previous rounds will always be impacted in future rounds when you increase the total number of shares in your employee stock option plan. So usually your first round, you might want to just earmark between 5 and 10% of the shares and put that aside. But in future rounds, it'll be part of the negotiations of, okay, how much is in your ESOP plan? What does your share plan look like? Okay, how much do you need to put in there? How will that impact the new investment? So between 5 and 10, maybe up to 15% for employees. In terms of how much can founders keep at the end, on one hand, you want to keep as much as possible. On the other hand, we need to be realistic, and you are going to give up a large percent of your company to raise the capital you need. Don't forget that each round is dilutive. So if you as a founder give up 50% of your company in the first round, and then 50% of your company is being given up again in the second round, it's not that you now have 0%, it's that you have 33%, even though you just gave up 50% in the second round. So every subsequent round is giving up control, not just from the founders, but also from the investors who invested previously. So keep that in mind when you're doing your math. But most founders will probably end up with around 30% of the business, but that is assumptions based on the current trends of the market and what people are willing to invest in businesses for, what the potential of your business includes, what your valuation is going to be. Like, there's so many factors involved. It's really hard to say, like, okay, it should be 42% for founders, and you're in mining, so it should be 10% for founders. It's really hard to do that for businesses. It's something that's going to evolve over time, and that's really part of that founder's dilemma. So understanding, wow, okay, I'm going out to investors right now and nobody's willing to get involved because of the valuation I've given the business and the amount I'm trying to give up right now. They want more and they want a lower valuation. That's the reality of the market at the moment. And so you'll be in those sort of situations. That's why I think, picking the right investors is really important, and keeping the goals aligned between the investors and the founders is critical. So yeah, you want to keep as much as you can, but you also want to give up as much as you need to achieve your goals. It might be something that would be easier in a one-on-one discussion. I could look at sort of your current situation and sort of what seems to be realistic, but yeah.
Yeah, and if you haven't, I put that link in to book one-on-one at the beginning. I'll put it in at the end. Can existing investors ask for additional shares in a down round to keep their original stake?
Well, nobody's getting shares for free. So if they want to invest as part of the down round, most certainly they're allowed to invest to keep their holdings. They don't just get given shares as part of the round. That's why it's a down round. The challenge when you're doing something like that is, as soon as it's not just you who's the person issuing shares, you now have many other investors giving away shares like that. You can't just create shares and give them for nothing. The board has to agree to issue shares, all depending on your shareholders' agreement. And so essentially, you're going to have to be in a situation where you've determined a price for those shares that are being given away. If you give some shares away for nothing, you've priced those shares at 0 cents per share, and that will impact the value of your round and the value of everything else, because you're giving away a portion of your shares at 0. So the average price of the round just went down again, and all the other investors who are all participating in the down round are going to be pissed that you're giving shares for free to this other guy. So as soon as...
So I meant actually giving them no new investment since their investment has decreased in a down round. So I don't understand the question then.
Yeah, so you can't give shares for no new money, because then the value of the business hasn't changed and you haven't gotten any additional capital.
So I guess I'm maybe if they want to keep their original stake, they can buy those.
Yes.
Yeah, absolutely.
Yeah, but it's not something where... Let's think about it from your perspective as a founder. You're going out to raise capital. You like having 50% of the shares. But I need to issue new shares to get new investment in. You can't just issue yourself directly more shares for nothing in order to keep your control at 50%. That doesn't work. What you'd have to do is have a board meeting, come to an agreement about remuneration for employees and for founders, and potentially create an option plan for yourself as a founder. So if you hit certain milestones, you will get stock options for free as your as your payment. Okay, I see you've responded. In the case of a convertible debenture where valuation is delayed, so you've got a safe. So with the safe, and actually a lot of investors in Canada don't like safes specifically because of what we're talking about, and they don't actually have any piece of the company. So let's say somebody invests through a safe and then the business never hits a valuation round and fails. Because they've just invested through a safe, they're not a creditor and they're not an equity shareholder. So they don't have any say on any assets of the business. So they're kind of stranded in the wind a little bit in this sort of situation. If they have a safe and you haven't had a valuation round yet, then they're unaffected and you can go and issue whatever other safe terms you want to other people. Their safe agreement is signed and you have their money. If a safe has transpired and you've already had your valuation round, then their shares have converted already based on your valuation round. So maybe we can talk about this more in a one-on-one, or you can shoot me a LinkedIn message. But essentially, your original investors during a down round are going to get screwed and they're going to be pissed. And there's no way around that because that's the reality of your business. And they're going to be pissed at you because you didn't deliver on the thing that you said you would. And that's the reality of it. And that's actually why at Equivasto, when companies come to raise with us, we work hard to sort of explain why we can't give you a sky high valuation. We have companies come and say, my business is worth 15 million and I want to raise $1 million and issue, only a tiny percent of my business based on my really high valuation. And one, it doesn't make sense right now. And so we, in allowing that, are doing a disservice to our investors on the platform. And we have a legal obligation to protect their interests as well as yours as a business. But also, all you're doing is screwing yourself. Because if you can't deliver on this, everyone who believed in you when you had nothing will now be really upset. And that will put a lot of strain on you when you try to go out and raise in the future, because they'll all be angry and you'll be asking them for a referral to another investor who's a friend of theirs. So you want to think about that relationship, but you also want to be upfront and honest. These people are on the journey with you and they want to see your business succeed. So being really clear and saying, hey, these things happened. These mistakes were made, but this is how we're learning and moving forward by these mistakes. We're not staying down. We're getting back up. We're pivoting. We're doing this and this and this. We are still 100% focused on achieving the goals that we've set out initially, or these new goals. We're sorry about what's happened, but we're not going to let that stop us. Then you can get them back on board again.
So how open are investors to non-voting and differential voting shares?
It entirely depends on the type of investor that you're looking to raise from. So with equity crowdfunding, for example, if you're letting the general public invest in really small amounts, these people are not interested in necessarily controlling and taking over your business. They're looking for an opportunity to support something exciting that you're doing, become part of your journey, and to potentially receive some financial returns from what your business is up to. So in that sort of situation, they would be more comfortable with non-voting shares because their holding would be so small, they wouldn't be exercising their voting rights. However, if you're going out to angel investors or a VC, and they're giving you $100,000, $500,000, $1 million of their own money, I would assume very strongly that they're going to want voting control, at least adequate to the number of shares they have, if not more, and a board seat and this, that, and the other, because they want to make sure that they can keep an eye on what you're doing and that you're delivering on the things that you promised.
Agreed. And the difference from an angel, a VC, or private equity, are they generally the same?
They're not the same, and it's a great question, and they're essentially different stages. That's the easiest way to summarize it, but they're actually different types of individuals, and the type of money they're bringing is different. But we'll start with angels. They come first. Angels are individuals. They're people who have personal wealth, and they're going to give you some of their personal wealth as an angel investor or what's called an accredited investor. So they're investing smaller amounts, probably between 25 and maybe 500,000. Usually you're not getting more than 500,000 from a single one person unless they're a super angel or something else. But they are individuals using their own personal experience and their own personal money to invest in you. So they're going to be laser focused on what you're up to, or they'll be laser focused on the lead angel investor who will be laser focused on what you're up to. They're a whole different range of sophistication because, again, they're all people. So some of them are super focused on financials and, mathematical sophistication. Some of them are more gut feel and like, how does it feel to work with this business and these founders? Do I trust them? Do I like them? There's a whole range in between. And they're a little bit harder to find. Some of them are part of angel syndicates. Some of them, it's just about who you know and networking at events, which, Toronto Starts usually has great networking events when COVID is over. Hopefully that comes back. But angels are individuals who you want to meet and connect with. Next in line, venture capitalists. So they're at the next stage. They're usually investing in the millions, not in the hundreds of thousands. And venture capitalists are individuals who went out and raised a fund. So they found other investors to give them money, and they're charging those investors fees and they're being paid salaries to take those people's money in a big fund and invest that in other businesses. So with venture capitalists, they're doing this as a professional job. If they don't find businesses that deliver the returns that they've promised to their own investors, they're going to get fired or they'll never be able to raise a fund again. So they are professionals, they are very focused, and they have specific goals and milestones relating to their own fund. So each fund will generally have goals and targets around return that they're looking for, timeline that they're looking for, and industry that they want to operate in, because they have to offer that fund to investors. So if a high net worth investor says, I'm looking to invest in, fintech companies and I'm looking for X% return every year, they're going to look for a VC fund that they can put their money into that's going to match or promise to match that sort of return profile. So when you think about VCs and angels, they're both looking for that 1 in a million kind of company that's going to go huge. But angels are individuals, so they have their own personal preferences, while VCs are professional firms that are trying to deliver on some promises on that side. Even larger than that is private equity. And so they're large corporations investing tens or hundreds of millions of dollars, usually in the final stages. And they're specialists in taking businesses in certain industries from, okay, you've been a startup, then you're a scale up. Now they're helping you sort of rocket towards eventually going public, essentially. So they're looking to provide that huge punch of capital to help you either go public or to deliver them massive returns over a long period of time. So their focus and goals are very different, and each PE firm is also going to be very different than the other, depending on the area in which they operate. So yes, they're all different, but they're all looking to invest for strong financial returns.
So now that we understand them, is there a way for a startup to curtail their offering to target specific types of investors? For example, an institutional investor as opposed to an individual investor. This person's thinking that low-risk institutional investors may be more favorable than high-risk individual investment over time, thereby justifying a lower valuation or a limited initial offer.
Definitely. I think when you're a really small business where you're usually getting invested in by angels, you're not the target of low-risk institutional money. Any situation where you're looking potentially for low-risk institutional money, they're most likely going to be working with some combination of VCs, or they're going to have an investment arm of their own business that is looking for very specific targets. So it's going to be industry focused, and you want to make sure that you're building connections and building stability in your business in whatever industries that they want to operate in. I think it's a great question, and it's something that's really worth diving into. I don't think there's necessarily enough time right now to kind of surmise all the details that you're looking for. I think if you think about the trajectory of your business, you mentioned it in your question. If you're looking for 0 to 100 unicorn in 5 to 7 years, 10x return, that sort of thing is not going to be attracting the sort of lower risk institutional money. They're going to be looking for a strong business with good fundamentals that is going to be making a lot of money, but will be something that will fit into potentially their portfolio of companies that they've invested in. It'll help them balance out different risks and will provide that consistent return. So that's more of a dividend potential model or something like that. So there's a lot of conversation about that, but not really enough for right now.
So I got a couple, hopefully, quick questions. Is there any max cap that companies can raise from your platform?
Yes, through equity crowdfunding, the most you can raise in one calendar year is $1.5 million. If you're looking to raise with less paperwork, the most you can raise is $250,000 per round, with the most of 2 rounds per year. So if you're looking to do minimum paperwork as possible, the most per year is $500,000. If you're looking for the maximum you can raise using pure equity crowdfunding, that's 1.5 million. And depending on the company and the structure of the business, we're willing to talk to businesses looking to raise up to 10 million, but that is a very unique circumstance. So I would in general say 1.5 million is the top.
Yeah, and if you're looking, you can book a one-on-one meeting with Alex. The link's there in the chat room. And we got 2 spots left, I think, this Friday. Last question here. Does your firm do any work with entrepreneurship by acquisition of operating traditional companies?
So that's something that is possible to discuss. Usually with equity crowdfunding, the rules specifically prohibit the raising of equity crowdfunding funds specifically to purchase a business. So if you're looking to essentially raise a bunch of money to buy an existing business or buy out someone else, equity crowdfunding might not be something you could use for that. But send me an email and we can talk about your unique situation and see how the fit is. I'd have to ask a few more questions about your business.
Another follow-up here. Why the difference between 500K and 1.5 million? Is it 2 different things?
There's a few other webinars Craig and I have done around how equity crowdfunding works. Essentially, when you're raising capital, the government has created a series of doors or pathways to raising capital. Whenever you raise capital, you are using a door the government has created, whether you know it or not. So even if you're raising from a VC or you're raising from your uncle, you're still using a door that government has created. So with equity crowdfunding, it's not just one door. There's a few different doors requiring different amounts of documentation, different reporting requirements, different accounting statements, different things like that. So if you go through the smaller door, that's easier and a bit more streamlined. There's a cap on the amount you can raise of the 500K and 250K rounds. If you go through the larger door, that requires accountant prepared statements and considerably more documentation, then you can hit up to the 1.5 million. Also, the doors are different in each province because Canada is a great country and we have securities regulators for each individual provinces and they don't all agree. So we can talk about that in another time, or you can look at the other webinars we've done.
Yeah, Amit, I'll send you the links to the other one where we break down this specific thing in detail and all the different requirements for each of the levels, because we did that. That's a long conversation, and we did that all to itself. So
if you're looking for the first crumb on your journey, Amit, the doors are called prospectus exemptions. So if you Google prospectus exemptions Ontario, you can read some really, really dry government documents about that. Or you can head to equivasto.com/learn, go to the company section, and we provide all those details for you there.
Yeah, and ping me. I'll send you the links to the stuff we've done before. And Alex, if people want to find out more, you mentioned a couple of times people could email you or reach you on LinkedIn. Where would they do that?
Yeah, so you can just head to equivasto.com. There's a lot of information there. You can send me an email at alexander.morsink@equivasto.com. You can find me on LinkedIn, Alexander Morsink as well. And you can message me sort of any of those places. You can check out Equivasto also on Instagram at Equivasto. Yeah, there's a lot of different ways to find me. I'm sure if you just type my name into Google, lots of things will come up.
And one more time for the link to book, I just put in the link if you want to, we're just about to hang up here. Click on that link if you want to book one-on-one with Alex this Friday. Thank you, everyone, for the questions. They were great. Thank you, Alex, for taking the time today. And we'll see you again soon. Appreciate all the info.
Thank you, Craig. Thanks, everyone. Bye.